Avinash, I want to run you through, because it's a special day. Markets on Monday have closed. Tuesday is a holiday. I think let's give our viewers something to really mull over for the next trading session before it resumes on Wednesday. And this again is around the frenzy of the Mama Earth IPO, and thereby a company really trying to stand up to the big daddies of the FMCG space, including HUL. But numbers as we see it have been a little tepid when it comes to not just Mama Earth, not just Honasa, but the entire startup unicorns that have gone ahead and listed. So let's pull up some of that data for you, Avinash. Should we? A little bit of research that we've done on market capitalization versus pre-IPO valuation of companies. And the pattern that emerges is that in more cases than not, the pre-IPO valuation of these unicorn startups seems to be ahead of what the market has corrected it to. So let's look at that data. To begin with, let's look at Paytm. Paytm pre-IPO valued at about $16 billion, and market cap as of today stands at just about $6.78 billion. Zomato, being an outlier which has now become a multi-bagger, had a valuation of about 5.4 billion and has gone up about 2.5 times since its IPO. But look at the case, even Nykaa being an exception, valuation more than doubling. But add to that, the despair coming from companies like Policy Bazaar, where valuation has tanked from 6 billion to a market correction of about 4.04, just about 4 billion or so. And Mama Earth Honasa, valued last year at 3 billion, and the market's telling it that your real value is actually not 3 billion but 1.2 billion or so. What do you make of this data, Avinash? Do you think markets have given unicorns a reality check and inflated valuation pre-IPO, where profitability is not a question, but only growth at all cost is? Do you think it is some sort of a realization, some sort of a correction, that just going after customer acquisition is not enough and your numbers need to shore up even when it comes to revenue and profitability?
Yeah, I think Karthik, you mentioned right that most of these, unicorns. Yeah, I can hear you.
Go ahead, please.
Yeah. So basically, Karthik, all these unicorns like Paytm, Zomato, Policy Bazaar, or Honasa, which got listed recently, I think the key element was the valuation of these companies. I think it was purely based on the footfalls or the eyeballs without focus on the cash flow generated by these businesses. I think today there has been a very growing realization in the markets for most of these fintech companies that they have to be cash positive, they have to make EBITDA positive operations, and most importantly, if you hear the commentary from Paytm or Zomato, I think they have clearly understood that the market wants them to be profitable, at least at the operating level. I think Paytm has already said that by September next year, they will be EBITDA positive. Zomato has been doing exceedingly well, and that's why the market has re-rated this stock. And plus, within its space, there is hardly any competition except for Swiggy and Zomato. There are only two food delivery players, which clearly shows that this place is clearly monopolized by Zomato and Swiggy. So to that extent, the market has been liking Zomato. But now coming to Honasa, my sense is that this is a company which does not manufacture any products. It outsources almost everything which it manufactures, or spends almost 40% of its revenue on advertising. And the biggest negative for this company has been that it has been unable to retain its customers. It's been able to attract new customers, but
Yeah.
something which the market likes is retention of customers, which has not happened till now. And valuations still seem to be pretty aggressive. I think we will have to see the next couple of quarters how Honasa delivers on the numbers, because if the numbers are tepid, if the numbers don't deliver as per the market expectations, then I think already we saw the stock coming down to a low of 277. It has again bounced back to around 315 odd levels. My sense is the market should look at the earnings growth trajectory and the operating margin trajectory, which I think is going to take a long time for Honasa. So I think it's better to keep away from some companies where the visibility of revenue, where the visibility of profits and the visibility of earnings growth is still a long time away. So I think within this pack, I think I would be more positive on Zomato, where I think visibility is strong, the ownership pattern is very strong, and where the monopolistic position of the company can obviously propel it to grow much faster than the market.
Okay, so let's talk about Honasa, and in fact, let's pull up those graphics again of the pre-IPO valuation and the post-IPO market capitalization. Avinash, I want to understand from you, when you look at these brands as an analyst or as a student of the securities markets, how do you define the sectors that they operate in? You mentioned Honasa does not manufacture its own products. Is it fair to call it even an FMCG company? Or would you rather call it a marketing company? Similarly, if you look at the rest of them, Zomato, being in the food business, may not really be classified as a food company, but as a tech company. Policy Bazaar does not have its own insurance product. So is it again a tech company or is it an insurance company? So if you were to look at this entire list, what are the industry classifications that you would really give it? And hence, perhaps its valuation should be compared with that sector and not perhaps the sector of the products that it markets or sells.
So I think rightly pointed out, Karthik, all these companies are basically facilitators. If you talk about Zomato, Paytm, or typically even a Policy Bazaar, which does not manufacture anything, they are actually facilitators for converting into the product into revenue. In case of Honasa, I think very clearly they are largely a domestic marketing kind of company where they outsource the entire product and only the marketing and the branding is done by the company. Now, what is important is that clearly in terms of customer retention, I think that is something which the markets are not very comfortable. Even during the public issue time, this point was raised by a number of analysts that retention is very important. If you start building a business model where you spend almost 40% of your revenue on advertising, and that only helps you to increase your new customer base, but does not help you to retain your existing customer base, that is definitely something which is negative. So I think all said and done, whenever such kind of IPOs do come in, Karthik, the only simple way to look at them is to compare it with the products. But I think you're right in saying that they fall into a facilitator kind of category, and therefore valuations have to be seen in that light. Today, Honasa has managed to, get its issue oversubscribed by almost 11 times. But in terms of the risk reward and in terms of the wealth creating opportunity, it's going to take a long time. Markets are going to be sanguine about their earnings growth, the visibility of top line, the profitability. And I think to that extent, data centric, approach is very important. If the data is not going to come in very strongly, especially for the EBITDA and for the cash flow generation, then I think it's going to be an extremely difficult journey for a company like Honasa. So I think it's better to be a little watchful here rather than making a short term immediate call based on purely the price momentum.
All right, don't make a call based on the price momentum. Watch out for these companies is the word coming in from Avinash Gorakshakar. Avinash, always a pleasure having you here with us. Thank you so much for joining us on this episode. And we hope to keep having you back with us to make sense of this very, very complex animal called the stock markets and make it simple for our viewers as you always do. Thank you so much for joining us, Avinash.